Now that we have some fundamentals under our belt, we're going to start diving in and calculating cash flows using the indirect method. In order to do this, we're basically going to have to start with net income and then go through a series of steps in order to convert that net income to cash flows from operating activities. The way I like to simplify this is to provide you with a 6-step process in order to get cash flows from operating activities. So my 6 steps are going to summarize what is on the previous slide. So this is cash flows from operating activities using the indirect method. So this is the Berube patented 6-step process. If you do this, you will get it right every time. Step 1 is start with net income. I can't spell. Or net loss. And if it's net loss, it has to be a negative. Step 2 is add back non-cash expenses. Our non-cash expenses that we've talked about this semester would be depreciation, expense, amortization expense, which is basically the same as depreciation except for intangibles, and depletion expense, which is the same as depreciation except for natural resources, and then BDE, bad debt expense. Basically, those are non-cash expenses because they're not paid out. Depreciation, amortization, and depletion is the systematic allocation of the asset's cost over its life. And BDE, bad debt expense, is reflecting the amount we're not going to receive from customers. These aren't actually reflecting cash outflows for the business. So the effect that they have on net income is the expense would reduce net income. So net income, the effect, say, of $100 in depreciation would make net income go down $100, but the cash flow effect would be 0 because there is no cash flow for depreciation. So step 2 fixes or converts the net income effect to the cash flow effect. How do we get from negative 100 to 0? We would add the 100 depreciation expense back in order to convert from net income to the cash flow effect. So that's why step 2 exists. The non-cash expenses impact net income but not cash flows, so we basically have to reverse the effect that they have on net income to get to the cash flow effect. Step 3 is going to be to add back losses and subtract gains on sales of long-term assets. Remember, long-term asset-related stuff belongs in investing. So what step 3 does is it kicks out the losses and the gains related to those sales of long-term assets. It kicks them out of the operating section because it should impact the investing section, not the operating section. So losses make net income go down. So to kick them out, you add it back. Gains make income go up, so to kick those out, you subtract them. Basically, what step 3 does is it erases losses and gains because it doesn't belong in the operating section. It belongs in the investing section. Step 4 deals with our current assets. We're going to add decreases in current assets. And we're going to subtract increases in current assets. And to be clear, I should say other than cash. We can't include cash here. We're trying to solve for the change in cash. And I'll explain why we do that in a second. Just bear with me. Step 5 would be add increases in current liabilities and subtract decreases in current liabilities. Now you just do it and you'll get it right, but it's probably a good idea to understand why. So let's go through an example of a current asset other than cash, accounts receivable. So for accounts receivable to go from, say, 100 to 90, what has to happen? Well, in order for account receivable to go to 100, from 100 to 90, it means that we must have collected more money than we sold. So as an example, if we sold 200, in order for this to work, we must have received 210. So 200 plus 100 is 300 minus 210 is 90. So what that means is the amount that we collected is more than the amount that we sold. I'm sorry, that keeps happening. So this is my collections. So the amount we collect is more than the amount that we sold on account. So in our net income, we're going to have the sales of 200, but we actually collected 210. So we collected 10,000 or $10 more than we have in our income from our sales. So that's why the rule for number 4 is when we have a decrease in a current asset, we add decreases in current assets. Because the reason we have a decrease in a current asset is because we collected more money than we sold. So in order to convert the net income part, which has the 200 in sales in it, to the collection part, which is 210, we have to add that decrease in accounts receivable. Again, all we're doing is following the rule, add decreases in current assets, and we get it right. But I'm trying to here explain to you why the rule exists, why it works. Let's try it with a liability, account payable. Why would account payable, let's make it go up. Account payable will go up, say, from 100 to 110 because we purchased more on account than we paid. So if we purchased 200 on account, that's our purchases. And that means we only paid 190. So in our accounts payable, we have the 200 in purchases. That would have affected net income, reducing our net income, but we didn't pay $200. We only paid 190. So to convert the net income effect showing the negative 200 from our purchases to the amount we actually paid of 190, that difference, 100 to 110 of 10, because it went up, has to be added. So the net income effect would be negative 200. We'd have to add the 10 to that to bring it down to negative 190. So that's why it says add increases in current liabilities. Those are the reasons why the steps work. Again, just do it. You'll get it right. But this is the reason why it works, because of the fundamental way that the receivable and payable accounts work. Owls! Sorry if you're wearing earphones. I didn't just lose my mind. I said owls, A-O-L-S. The way I remember step 4 and 5 is assets opposite, liabilities the same. So we add decreases and subtract increases. Those are opposite directions in our current assets, but we go in the same direction, add increases and subtract decreases in our current liabilities. Owls, A-O-L-S. And then finally, step 6 is going to be add 1 to 5 to get cash flows from operating activities. And again, it may seem complex, but really if you just follow these steps each and every time, you'll always arrive at the right answer. And we're going to go through and practice more and hopefully give you a better understanding of why these rules exist. So these are the steps that we're going to follow. Okay. So again, we talked about adjusting for gains and losses. That was step 3 in my 6-step process. So the cash we receive from the sale or disposal of long-term assets is classified as an investing cash flow. The gains and losses are on the income statement, so we have to eliminate them. And the way we erase or eliminate the gains is we subtract them, and then to get rid of the losses, we add them back. So let's look at the National Beverage statement of cash flows. It starts with our net income, and then we add back our non-cash expenses. So start with net income is my step 1. Okay, the book says step 1's adding net income to depreciation. Step 1, start with net income. Step 2, add back your non-cash expenses. That's what's happening there. Then we're going to move on to dealing with our current assets and current liabilities. So step 1 is the net income under my method. Step 2, add back non-cash expenses. Step 3 would be gains and losses, but in this case, National Beverage doesn't have any. So don't freak out on an exam question. If you're going through the 6 steps and you see there aren't any gains and losses, no worries, just skip that step. And then you move forward to step 4. Step 4 is assets opposite. So our accounts receivable is opposite. So if accounts receivable went up, we would subtract. So we would have to look at a balance sheet to determine what happened to the receivable, and we would determine that the receivable went up, which is why we're subtracting. Same with inventories and our prepaids. So this is step 4. We're subtracting increases in current assets. So all of these 3 current assets must have went up during the period because they're being subtracted. And then with current liabilities, that's OOS. Liabilities the same, LS. So if we're adding those, the liabilities must have went down. Must have went up as well. So we add increases in current liabilities. So that's what's happening right there. How would we determine that change in current asset or current liability? We would have to look at an income statement. And we'd have to look at a balance sheet. So let's take a look at the balance sheet and just see that what I told you is in fact right. So we had the balance sheet for National Beverage a few slides back. And here it is. So you could see that accounts receivable, inventory, and prepaid, those all went up. They went up for each one, and the rule is AULS, so assets opposite. So that's why each of those changes are subtracted. And then in our current liabilities, those went up as well, which is why we add those changes. So assets are opposite. We're subtracting all of those increases in current assets, and liabilities are the same. We end up adding the increases in our current liabilities. So if I go back to our slide here, we can see that indeed all of the asset changes that went up, we subtract, and the liabilities that went up, we end up adding to arrive at the net cash provided by operating activities. Again, to kind of further explain why we do what we do, why AULS exists, here's the accounts receivable laid out for us. So we have a beginning balance of 61,046, then we have revenue of 826,918, and then collections of 816,645, and the ending cash balance is 71,319. The change was 10,273. What we want on the cash flow statement is effectively the 816,645 that was collected. But what we have is the effect on net income, which is 826,918. Well, the change is a positive 10,273, and the rule says we subtract increases in current assets. So we have an increase in accounts receivable of 10,273, which we're going to subtract, and lo and behold, that's going to convert our net income effect, 826,918, to our cash effect $816,645. So the reason AULs exists, again, is to convert the net income to the cash flow. So the net income effect is the sales on account. That's what would have affected net income. But we're on the cash flow looking for the cash receipts, not the sales. So by doing this conversion, subtracting the increase in accounts receivable, we're able to convert the net income to cash flow. Again, just do the step, but this is why the step works. Looking at account payable, same deal. So we've got accounts payable beginning balance, and then we have an increase to arrive at the ending balance. Why does that increase exist? Well, they don't give us the actual numbers for the company here, but I can make something up. I could say that they must have purchased $100,000 worth of stuff. So then in order for this mathematically to work, their payments would have been $49,391 plus $100,000 minus $58,100. The payments must have only been $91,291. Again, the goal is to take the net income effect, which would be those purchases. So the net income effect of $100,000, we want to convert to the cash effect. The rule says we add increases in current liabilities like account payable. Account payable went up by $87.09, and when I add the $87.09, I'm going to get the cash effect. First, the net income effect is negative because when we purchase things, that's going to decrease our net income. It increases our expenses. And then we add the $87.09 and we arrive at $91,291. It's negative because it's a cash outflow. So the difference when we're dealing with liabilities are affected by expenses. The expenses decrease net income, so we're converting the expense effect to the cash effect. And that's again why the AULs works. Financial analysts generally avoid firms that have rising net income but falling cash flows, because if a company cannot convert that net income into cash, it basically means that they're going to have difficulty paying their debts when they become due, and they're also not going to have the ability to pay dividends and expand the company. Creditors are not going to lend money if they don't believe the cash generated from operations will be available to pay back the loan, because just like investors want to make a return on investment, creditors want to make sure that they'll be paid back.